Year to date, the S&P 500 index has gone down by 25%. With inflation at 40-year high and the housing market cooling down, and layoffs and hiring freezes at big tech companies, many people are worried that there will be a recession in the US soon. So how do you invest with so many uncertainties? Wouldn't it be nice to have a simple strategy that you could follow that also reduces anxiety and stress? Well, that's what I will talk about today: dollar cost averaging in the bear market. Hi, I'm Prudence Zhu, CPA and financial planner. I have a decade of experience in investment and finance. I became financially free in 2021 through saving and investing. I'm here to inspire and empower you to build your financial freedom and live the life you want and deserve. First of all, what is dollar cost averaging, or DCA? It is a long-term investment strategy. It means regularly invest in small amounts instead of a lump sum of money all at once. That means when the market goes up, you consistently invest with the same dollar amount on a weekly, bi-weekly, or monthly basis, or whatever frequency you feel comfortable with. And if the market goes down, you do the same. Effectively, this removes a lot of the anxiety in picking and timing your investments. This strategy is particularly beneficial in a bear market because it lowers your average cost per share. Before we dive into why dollar cost averaging is a good strategy in a bear market, let's take a step back and look at the bigger picture. We know the stock market goes in cycles every few years. Looking at the data since 1950, including the short dip in 2020, we had 15 bear markets, almost one every 5 years. And it has lasted 338 days on average, a bit over 11 months. And it has taken 303 days to recover to the previous high, so about 1.7 years. So over the long run, we should be confident that the market will recover and continue to increase in value. If you don't believe the data or me, maybe hearing it from Warren Buffett would help.
I know what markets are going to do over a long period of time. They're going to go up.
So that's to say, if your time horizon is long, meaning you don't need the money for at least a few years, for example 5 to 10 years or longer, then you can still comfortably invest in the stock market. That means that the money you are saving and investing for retirement, which might be many years down the road, shouldn't be impacted much by the market downturn, if you are consistent with your investment and don't take emotional decisions. However, because the drop is only temporary, we know that on average, 1.7 years later, the market would return to where it was before and keep going up. And since you don't need the money when the market is down, you shouldn't take it out or stop the investments. And dollar cost averaging would give you the best chance of generating a good return. To make it easier to understand, here's an example. Buying Boris and averaging Abby both have a relatively long time horizon, and they both have $8,000 to invest in the stock market. So Boris invested a lump sum of $8,000 when the stock price was $10 per share, and then left it there. And averaging Abby invested $1,000 regularly, no matter if the market goes up or down. Mind you, here we have a normal market, not a bear market. Even so, Abby already got ahead when the stock price returned to $10. Because even though the stock price went up and down, it was lower than $10 per share most of the time. So Abby effectively lowered her average cost using DCA to $9.6 per share, even though the average stock price for the whole period was slightly over $10. In the end, Boris had a 0% return, whereas Abby had a 4% return, even with half of the money sitting idle on average. And here's an extreme example of a bear market. Now both Boris and Abby have $400 to invest. So again, Boris bought a lump sum when the price was $10 per share, and Abby spread the money out and invested $100 periodically. And since the stock price has dropped by quite a bit, she was able to purchase a lot more shares than Boris. And when the market recovered, she now has 90 shares valued at $900, but Boris still only had $400. Buy and hold is not the worst case scenario. I see way too often that buying Boris turns into panicked Peter in a bear market. Now Peter feels like he needs to get out of the market before the price drops even more. So instead of keeping the stocks until the price recovers, Peter sold all of his shares when the price declined to avoid further losses.
But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16 and then it got to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now.
So at the end of the day, Peter would end up with $200 or $80, depending on when he sold. So by the time the bear market is over, Peter's assets would have significantly shrunk, Boris about the same, and Abby more than 2 times when she started. And that's probably why JP Morgan said, in bear markets, stocks return to their rightful owners. And those rightful owners would purchase even more when the prices are low. And in the end, they would be the winner if the market recovers. For long-term investors, it is critical to have an emergency fund so that you don't run into a situation where you need some cash, but the stock market is down. Liquidating your asset when the market is low could jeopardize your financial success down the road. Because if you do, you will lose your investment at a miserable time, and probably later you won't have the opportunity or the resources to go back in when the prices are still low. And the other thing is that you could use the principle of dollar cost averaging for different kinds of transactions to lower your risk of market fluctuation. For example, you can apply it to mutual funds or index funds, convert money from one currency to another, or even fill up your tank at the gas station. Here's a research by Yale University in 2017. The investment strategy of dollar cost averaging into the US stock market between 1960 to 2017 have much lower risk than investing with the lump sum strategy. And statistically, it is shown as a lower standard deviation or less severe fluctuation. And that's because DCA effectively smoothes out the unit cost of investing and is gradually exposed to asset risk instead of all at once. Moreover, when you regularly invest, regardless of the market performance, you will be in the market more often and more likely to benefit from the growth, which happens most of the time in general. Not to mention the time saved timing the market and the emotional roller coasters most people experience when the market takes a dive. To most effectively allocate your investment in a bear market, you should also consider the tax implications of different accounts. After-tax retirement accounts such as Roth IRA and Roth 401k provide tax-free gain and are thus more beneficial to investing when asset prices are low. For example, if you invest in an S&P 500 index fund at 3,577, and when it recovers to the previous high of 4,796, your return would be 34%. However, if that investment is in your brokerage account, it would be subject to capital gain tax for long-term gain and ordinary tax for short-term gain. That is, if you hold the investment for 1 year or less. But if the investment is in your tax-deferred account, such as 401k, the applicable tax rate at the time of distribution would also be the ordinary tax rate. That's why in a bear market, many people take advantage of low asset prices to convert money from 401k to traditional IRA and then to Roth IRA. But please note that conversion from a tax-deferred account to an after-tax retirement account would trigger income tax liabilities. To summarize, dollar cost averaging or DCA is a great investment strategy in a bear market. It would likely lower your average cost per share, build a habit of investing, no need to think about timing or how much to invest, and reduce the anxiety by helping people look at the long term. Furthermore, you can optimize your allocation in accounts with different tax implications to maximize your return. I hope today's episode inspired you on your strategy investing in a bear market. If you liked it, please give it a thumbs up and share it with others. We are also available on your favorite podcast platform under Invest with Prudence. Please subscribe to my channel if you want to learn more strategies to build your financial success and live the life you want. See you next time!